right, yes, perfect. So first of all, what did we go over in the previous video? We went over simplifying. And when we went over simplifying, we also mentioned that our psychology should also be approached through technical analysis. As in, our environment that we are trading in should not support the idea of overtrading, of having emotional errors, etc. So our environment should be very easy to actually keep our psychology in check. It should support our psychology. And that is very important, and that is what we're going to go over. Now, of course, there's also limits to this, which we'll also go over eventually in this week. The first thing that we are going to go over and how we are going to approach this is alerts. We are going to be using alerts for every step in our trading. Every single step. And what I mean by that is that right here, for every foundation level, for bias, narrative, boundary, target, entry pattern, and risk management, for every step, we can use alerts. Now, for our bias, I would argue, which is the first step, for our bias, I would argue we can always get to a bias. As in, the bias is always quite clear. We're either going higher or we're going lower. So for that step, we don't really need an alert. One of many pairs is likely higher probability than the other pairs. So that is the better bias to trade. All right, then that narrative, where are we actually going higher from? That is where we need to start utilizing alerts. So what does that look like? Here on New Zealand dollar, US dollar, if we just simply do a top-down analysis, we came into this monthly fair value gap sitting right there. We tried to push lower off of that monthly fair value gap. We failed to do so, which means we are now overtaking that monthly fair value gap and potentially creating a new bullish monthly fair value gap as well. All right, well, that is the bias currently. We can't really use any alerts right there. But if we now want to continue higher, then where are we likely continuing higher from? Well, we don't have a monthly fair value gap just yet, so there's nothing really to work with. All right, there we have a primary in the form of that swing high, quite far away currently. So let's see if we can find one lower. On the weekly, not really, but on the weekly, we can see that we have this weekly fair value gap right there, which we could continue higher from. So if we want to continue higher right there, then what is the first alert that we use? The first alert is we have the alert right there set at the discount array that we actually expect higher prices from. So why do we actually use these alerts right here? These alerts are to minimize the risk of error. And what that means is the longer we stare at a chart, likely the more errors you are going to make in your head as well. And the way I always like to see that is that if you open up a chart and you can clearly see where it's heading, where it's heading higher from, you have the bias very easily, narrative very easily. Within about 30 seconds, you can get to each step. So it takes you around 30 seconds to get to a bias, 30 seconds for a narrative, 30 seconds for a boundary, 30 seconds for the target, 30 seconds for your entry pattern. That's around the ideal time frame what you want to have. If you need around 5 minutes to get to your bias, then likely there's just simply no bias. If you need to get to if you need around 5 or even more minutes to get to a narrative, then likely there's just not a clean narrative right now. So that also helps us in understanding, all right, which pair is actually high probability. The pair that is high probability is the one that it's screaming at you. It's screaming at you as in the narrative here is just so obvious that if we are going higher, then that weekly fair value gap right there is super obvious that we might continue higher off of that. So it's screaming at us that there's no real other opportunity right there. As in, if we are going higher, that weekly fair value gap is literally perfect right there. Perfect. So it's screaming at us. We only needed around 30 seconds, potentially even less, to get to that clear drawn liquidity, get to that narrative, etc. So that is exactly what we want to have. That is the highest probability. So why is that important? Because if you do the opposite and you do not utilize alerts and you stare at a chart constantly. For example, here, if I were to stare at this chart, there's literally nothing I can do right now. All I need to wait for is that discount rate to be hit. But if I now start scrolling through other pairs as well, and I start looking at other scenarios, then I will always force an ID. The limit or the risk of messing up, the risk of forcing an ID becomes a lot higher the longer you stare at a chart. I think we can, or at least I'll tell you from my experience on why I think this is extremely underrated using alerts. Is because when I first started trading, I was looking at the chart the whole day. And I was basically just trying to trade because I thought it would be just like a normal job, right? Where you just look at the chart the whole day and you see if there's any opportunities throughout the day. That's a normal job where you just constantly working, essentially. And trading is the opposite, where you want to work the least amount as possible. Sounds very weird, but that is true. When you actually get to the trading stage, when you want to become profitable, you should trade the least amount possible. As in, my chart time throughout a day is, I would say, around 30 minutes. Around 30 minutes when I actually get to a profitable ID, or it's an unprofitable ID and I take a loss, or I do not have any ID at all at that moment in time. Around 30 minutes maximum. And that is quite long still, I would argue. So whenever I'm actually trading, my chart time is very little. It's extremely little. But this helps me to prevent that forcing, to prevent something to force an ID, or prevent FOMO, where you now think, all right, price already heading without me, I need to get in. It prevents that forcing. That is very, very important. So again, when I started trading, I was at the chart, you could argue 8 hours a day. And I was just staring at the chart, seeing if there was any opportunities. First, I had the learning curve, of course. Then I wanted to implement whatever I learned. And I did that through just staring at my chart consistently the whole day, which eventually, when I came into the charts, I did not really have a clue. As in, I did not really see anything clean. There was not really clean high probability price action. But over time, if I looked at the chart more and more and more and more, what happened? I started to sort of hallucinate, you could call it, where I start now to force IDs in my mind, where everyone can make up a beautiful drama story in the market right there if they just stare at the chart long enough. It's the same as if you start overthinking a scenario in your mind long enough of something that just didn't happen. But you start overthinking it. And then all of a sudden you come to a certain conclusion, which is just simply not true. Because you were thinking about it consistently. Constantly you were thinking about that scenario. And all of a sudden weird thoughts start popping into your mind. That's the same with the market. The market, if you stare at it long enough, you will come up with a conclusion on the market, which is likely just not true. The conclusion and that objective period where we need to focus on is when we open the chart. It should be the first 5 minutes. Maximum. That's the maximum amount of time. We should not need to know where it's going to go within an hour. An hour is insane. That's an insane amount of time to actually analyze a certain pair before you get to a conclusion on what you should do. So if you don't know what to do, then that's also okay. Then you need to wait, most likely. And that waiting is usually unacceptable for traders because they're like, but there should always be something I should need to do. Yes, you're forgetting that waiting is also something you should need to do. So that is extremely important, and it's oftentimes overlooked. And it's oftentimes overlooked in our psychology as well. And using alerts here and understanding that we should minimize our chart time, that makes the environment really easy. It makes the environment perfect. Because if we do not do that, then it makes the environment really easy to mess up in our psychology. To now start forcing IDs, to force trade, to overtrade, all these type of things. And to be honest with you, the longer I stare at the chart, the more miserable I feel. If I stare at a chart more than any 4 hours on a day, I would argue, I feel absolutely horrible. I feel like, wow, I just wasted so much time. I got to no conclusion. I could have very well used alerts, and with that time, I can do something else as well, because I already know what the next step is. And that's the beautiful thing about our trading strategy as well right here. So if we go over alerts again, then with bias, we can't really get to an alert, as in it's not really necessary, the alert. Because the bias, you can always get to a bias before you actually need to utilize an alert. But with the narrative, this is the beautiful part. Because with step 2, 3, 4, and 5, and even 6 on the foundational levels, we know where and when we want to look for those. And the when is when the alert now goes off. So the where is quite easy because we know where we want to look for a narrative. Excuse me. Because we know where we want to look for our narrative. That is simply right there in that discount array. That is also the boundary. That also leads to the target. Now the target, you don't need to have an alert right now because the next step is the entry pattern. So the entry pattern is where you can have an alert again. So what would you do here? Well, we come into it right there and the alert goes off. All right, very obnoxious sound most likely. I have a very, very, very hard alert, as in it's very loud, which hurts my ears sometimes, but it's okay, as long as I can hear it. Perfect. So right there, the alert goes off. Now, what do I need to do? I need to look for my entry pattern. All right, so that's the next step. All right, is there a day agreeing, by the way, on to trade that day? Yes, agreeing. Perfect. We can go to the next step. Entry pattern right here. All right, what do I actually need to see? Well, this was a weekly Vervia gap right there. If I was to enter off of the 4 hour, then a 4 hour ST here would be enough. Would be enough to enter off that 4 hour ST. So what do I do right there? Well, the first time you are going to look at this daily or weekly Vervia gap right there, the PD rate, the discount rate that we want to trade off of, the discount rate where we want to look for our entry pattern, then right there, you likely have nothing to do. That's very simply said. And that's on the 1 minute, 5 minutes, 15 minutes. 1 minute, usually, of course, since it's the 1 minute, goes quite fast. You only need 3 minutes to actually create a 1 minute Vervia gap. So 1 minute is the only time frame where I might actually look at the entry pattern forming itself. It's the only time frame where I would do it. 5 minutes, I would walk away. 15 minutes, walk away. 1 hour, of course, walk away. 4 hour, definitely walk away. The higher we go, the more time we are going to wait. And the 1 minute time frame is usually quite fast in showing you what it wants to do. So the 1 minute is where I would say, yes, you can definitely stay at the chart and keep on looking. As long as you still understand, the longer it takes, the 1 minute right there, the more risk is going to creep into your mind to actually forcing an ID. And that is what we need to minimize. We need to control that part. Very important. So here, there's literally nothing for me to do because I'm just waiting for my entry pattern. So if I wake up and I see that right there, then the first thing I do is, well, all right, I just walk away again. But I do also understand that, all right, how long will it take now for us to create a Vervia gap? Well, 4 hour candles, and if a Vervia gap is being created, we have 3 candles. So it takes around, 12 hours. 4 times 3, 12 hours to create one potential 4 hour Vervia gap. Doesn't mean that we are going to create that in 12 hours. So here, right there, if we have an alert, then we can simply calculate, well, in 12 hours, what time will it be? Well, candles always open at the same time. As in here, we have 1 right there. Then after that, we have 5. And then after that, we have 9 right there. That is always the time where candles open. So when is the next candle opening right there? 13, 1 p.m. New York local time. All right, perfect. 1 p.m. New York local time. Let me set my alert right there for 1 p.m. And then I'll check again if there is a 4 hour Vervia gap sitting right there. And on that 4 hour Vervia gap, I can either do one of two things. And that is already predetermined. You've already predetermined what you are going to do right there. It's not last minute that you think, I'm going to either enter on the 4 hour Vervia gap, 4 hour ST right there, or I'm going to look at the 5 minutes inside that 4 hour ST. That's already predetermined, should already be in your plan, which we'll go over as well in MMP week eventually. But right there, now you just wait. So 1 p.m. New York local time, I have my alert set. Perfect. Once it goes off, I check the chart. Is there 4 hour Vervia gap? Yes, I act. No, I wait. And I do nothing. Perfect. So if we go over multiple examples right here. And I want to go over the short list to first show you some live examples as well on how I would go about it. So here on Euro New Zealand dollar, it's the same exact thing where on the monthly time frame, we are coming below that swing low right there on the monthly time frame. All right, that is a bit suspicious to me, as in if we want to continue lower, then we can definitely continue lower off that weekly fair value gap sitting right there. But keeping in mind that we might be sweeping it. So this is sort of the last line of defense right there. If we don't respect that, then I do think we can continue higher. Perfect. On the daily time frame, then there's nothing really for me to do unless we can create and we can trade the unusual context going into the weekly fair value gap right there. But if I were to trade off of the weekly fair value gap, then what would I do? The first alert would be again on the fair value gap itself, on the PD array, on the narrative, the boundary. Then the second entry is for your entry pattern. So the entry pattern right there on the 4 hour, waiting again. Here, same exact thing. Where if we create that fair value gap right now, what would it need to do? Well, we still have 3 hours to go if we potentially create that bearish fair value gap, which means then we have a confirmed ST. Perfect. So 1 p.m. New York local time, set my alert to wait for if we have a potential fair value gap being created. All right, perfect. Now, what is how we go about this in different scenarios as well? So if we take a look at, let's go over Euro US dollar. And let's go over the same examples that we already went over. Right there. And let's also go over indices after this one. So let's first go over this example where we had the daily fair value gap right there. Once we have a sting into the daily fair value gap, again, that is where an alert goes off. Right there. Alert goes off for that sting into the daily fair value gap. Perfect. So that means we can then target those highs. Let's see how we would then use our alerts for the actual entry pattern. So again, it's 2 alerts right there. It's for that narrative, that boundary. Same thing, because that is where we want to continue higher from. Target, you don't necessarily need an alert potentially after you get involved for your entry pattern, etc. Then you can use that alert for when you know the target is hit, etc. But right here, what do you want to do? You want to use an alert right there for your narrative, your boundary, and then for your entry pattern. And then the next step is, of course, risk management as well. So right here, if we look at this price action, we had, of course, the ST sitting right there, the ST, and we continued higher off of that right there to create 3. So how would you now use alerts right here? Well, depending on the session you were trading. Because of course, if you're trading Asia also, and which I would not advise, but if you were already looking at Asia right there, then you would maybe use them a little bit different because you would also use the ST. So here, what you want to do is, again, you want to do the same thing where we have the 15 minutes. So every 45 minutes, there's a potential fair value gap being created. Now, you also have indicators that set the alert for you. So when there's a fair value gap being created, they actually set off the alert itself, which also could be very nice. I personally use the timer method. I like it a little bit more. But the indicators, of course, that's also a great thing to use right there. When there's a fair value gap being created, the alert goes off. That is very handy. So right there, once we have this alert going off right there, what do we need right now? Well, we have the first fair value gap being created. All right, now we need to wait again. So we need to wait again. And we can see it's a London major, meaning that the London right there should create a new fair value gap higher before we even want to get involved. So here, what do we do? After this time right there, all we're waiting for is now, again, a new fair value gap higher being created. So again, setting that timer, 45 minutes right there. 45 minutes, is there a fair value gap? Right there. Well, at that candle open, we can already see the expansion phase. So when we look at the chart right there and our alert goes off, what do we see? We see this expansion phase right there, meaning that in the next 15 minutes, so we can again set that alert and just go do our thing. Because after that 15 minutes, now we know, okay, now there is a chance that we can get involved potentially. So now you want to pay attention because now there's actually something to do in the market. And now we need to actually execute on the ID right there. So when we actually execute on the ID, what do you do after this? Well, is there a reason to go break even right now? Or is there even a reason to keep on watching the chart right there? No, there's not. Why should we stare at the chart? It's like watching paint dry. It's nothing important, nothing relevant. It's just detrimental. It can only be detrimental right there. The only thing that can happen here if you stare at the chart is messing up in your psychology. That's the only thing that can happen. Nothing else. It's not like you'll see all of a sudden a secret or something. No. Only thing that can happen right there is that you mess up in your psychology. So for us to actually go break even, what do we need? Well, first of all, we need to wait for this candle to close right there. And we can potentially, if we use the odd right there, can go break even quite early. So every 15-minute candle, you can set an alert to see, all right, what did we do this 15-minute candle? What I like to do is I set alert for, again, the fair value gaps. So 45 minutes from now. And what I also like to do is I set an alert on where I would expect the new fair value gap to be created. Now, this is a little bit more advanced because I can also understand that it's quite difficult to first, when you're just starting out, to understand where the fair value gap might be created. But this is what I like to do. So for me, for example, I have my alert above this high. Above that previous candle high right there. Why that high? Well, if this candle wants to expand higher, then what will it do? It will create the expansion phase above that candle's high. Meaning that around there, the new fair value gap will be created. So once we see this right there and the alert goes off, what does that mean? That means that my alert's going off, and right there I can already go break even by just using alerts. So the chart time here, once we are actually in the entry and the risk management is actually being applied, will be a little bit more, but still we need to minimize that. As in, we still need to minimize the error of potentially messing up in our risk management. And the way I see it is the trade you are getting into is the most important. As in, that is where you want to have the least amount of chart time. The reason for that is because the goal is always to find the highest probability trade. Once you find the highest probability trade, and also, of course, what we went over is it helps to minimize the chart time right there, because that chart time allows you to stay objective, to have a clear state of mind, to actually look at the chart. Then once you have that, minimize the chart time as much as possible before you actually get into the entry, because that will also allow you to have a clear mind going into the entry. The risk management, you can allow yourself to have a little bit more chart time. Why is that? Well, that is because risk management, of course, requires a little bit of an active, proactive state where you're a little bit more aware of what is happening in the market. But it also, the way I see it is as well that the narrative and the entry pattern overall is what leads you to the highest probability trade. The risk management, if you just simply take a bad trade, it won't help the risk management. So whatever you do right there, it just simply won't help, because you already took a bad trade in the first instance, which means that the chart time might be bad in the first two steps, in the first two alerts, going over narrative and entry pattern, which then the risk management alerts become futile, meaning that if we take a high probability trade, then our risk management can become very easy usually, because the break even, etc., doesn't really matter if we have a high probability trade in the first instance. Meaning that we want to minimize our chart time as much as possible in the narrative and entry pattern alerts. That is what we want to use most of the time. Then overall, the narrative and entry pattern, the same amount of time will likely be taken for the both of those combined on just your risk management. That is fine, because you usually take a little bit more peeks at your trade. What is it currently doing? I need to be aware. What is the fair value gaps telling us, etc. As long as you understand, still in risk management, even though it's a little bit higher, your chart time is still going to be a lot less than if you were to stare at the chart consistently and constantly. That is very important to understand as well. So This is how you minimize your chart time right there. And again, once you are break even in this trade, there's nothing for you to do. So why stare at the chart? Because there's nothing for us to do. Literally nothing. So here, what do you want to do? You want to walk away and just simply close MetaTrader, close TradingView, and either wait for, you can set alerts. I don't even like to set alerts right here. I just wait and I go about my thing. I like to sort of forget that I even had a trade going on. And then when I open TradingView again, maybe to do analysis or something, or to do a forecast, and then I see, yes, I had a trade. Oh, okay, let me check. What did it do, etc. That is how I like to approach it. I almost like to forget about the trading in that sense. Because otherwise, from what I noticed as well is, yes, you can close your TradingView chart. Yes, you can close your MetaTrader. But if you're constantly on your phone and you're checking, what is it doing? Am I in profit? Is it close to take profit? Then you're essentially doing the same thing. So it's truly as well a little bit of self-control right there. As in, is there something that you can do besides trading which truly interests you, which takes all your focus and attention right there to get distracted from trading? Because trading at that moment is not relevant anymore. It's not important. You already did your thing. It's just the market playing out after that. It's just the probabilities playing out. Either plays out or it doesn't. Perfectly fine. I have done my job. So once you have done your job, step away. And also don't constantly peek at the thing, because you still start to overthink right there. Where if we have, for example, something like this, and we haven't hit take profit right there, then if you're constantly stare at your phone to check TradingView or something, then here you're going to panic. You're going to panic and think, oh my, what is happening right there? I need to get out of this trade. I might add on to the idea again, and then you might go break even impulsively. You might take profit impulsively where you shouldn't take profit. All those things is what we need to avoid. And that can all be avoided through limiting your chart time. That's it. That's simply it. Limiting your chart time. It's quite simple. Is it easy? It might not be easy in the beginning, but over time you'll grow into it as well. So that is very important. So right here on the 1 hour, how would you go about this? That right there is the entry. So that right there is the entry with the stop loss being right there, and our take profit, let's say 1 to 2 around there. Well, let's actually take the high just for risk management's sake. So here, again, the alert would be, all right, our entry pattern is formed. So the fair value gap right there is being formed. Perfect. Alert goes off. Nice. Then right there, all we need to do is we wait for that to be hit. Perfect. That is where we can actually look to enter now. So this candle, the most recent candle right there, is the only candle where you would actively look at the chart right there. This candle. Why is that? Because that candle is the candle that will be responsible for tagging you in. As in, will be responsible for you actually entering the trade right there. It will tag you into the trade. So that is the only candle that is relevant to look at on that 1 hour time frame. And again, that takes around, what is it? That takes around maybe 5 minutes maximum to actually get into trade. If you use a limit order, even less, which we'll also go over eventually. But if you use a limit order, it's just simply placing the limit order, the buy limit right there, and then again, going away from the chart. So right there, once you are in the trade, all this price action, yes, that is unpleasant price action. Exactly why you should not look at it, because it's not even relevant to look at it. And because it's unpleasant price action, at that moment in time, you might feel uncomfortable because you think, and I would also think that, don't get me wrong, everyone would think this, where you have the 1 hour value gap right there, and you think, well, we tried to continue higher, but we failed to do so. I want to get out of the trade. Well, that's not what I would think. I would say, all right, well, our stop loss is there for a reason. So let's just keep our stop loss right there and let it do its job right there. Because from somewhere in this leg, it can still continue high right there. Perfect. So we know that. So in the meantime, is there something for me to do here? No. So I simply walk away again. I simply walk away and I wait, and I potentially use the indicator for a value gap being created right there. Perfect. Using the indicator, nice. Indicator goes off right there. And then eventually I can allow myself to go break even, because after that, fair value gap is being created and the indicator would go off or your timer would go off, then right there, you would go break even right there. That is all you would need to do. That is exactly how you would use your risk management as well with alerts. So you're constantly, for every step, you're using alerts, every single step. And this is simply to minimize our chart time because we do not want to have a lot of chart time. Chart time, the more chart time equals to the more risk, the more error there's going to be on forcing an ID, on messing up overall. That is what we want to limit right there. So if we go over the indices, like we mentioned, and we look at the example we had with NFP right there. Overall, again, we are continuing higher. So the first step is we have this weekly fair value gap. Now, assuming that we are not trading towards it currently, so we just have the alert right there on the weekly fair value gap. All right, first alert right there is hit. Perfect. Remove the alert. All right, perfect. Then the next thing is, all right, if we go into the 4 hour right there, we have 4 hour ST, but we're waiting for that Friday to show what it wants to do. So on this Friday, we do not really know where it's likely continuing higher from. So the only thing we can do right here is set an alert for actual NFP. So 8:30 a.m. 8:30 a.m. we have an alert going off to see what NFP actually wants to do, which PD rate wants to sting into, etc. And then potentially continuing higher off of there. So what you can do is, if you are expecting a retracement, then ahead of NFP, what would you do? Well, simply place an alert right there below price action, because anywhere here, somewhere there, you could expect a retracement to then continue higher. All right, if we know that, then the alert right there goes off. Perfect. Going to the 5-minute time frame because we came into that 4 hour fair value gap right there. Nice. So on the 5-minute time frame, what are we seeing? Well, on the 5-minute time frame, a little bit ahead of that time, the first thing we see is we see a sting into the 4 hour fair value gap. At this moment in time, there's still nothing going on, right? So here we still wait and we can still walk away. So every 15 minutes, potentially a timer. All right, I need to stare at the chart for maybe, and again, when I say 15 minute right there and you set an alert, when that alert goes off, the timer goes off for the 15 minute, then all you would need to do is look at the chart for around 10 seconds to see if there's something interesting. Because that again leads to the point that if you stare, then after that alert, stare at the chart, you're likely going to force an ID again. So minimize that chart time as much as possible right there. And again, this is where the indicator for those fair value gaps being created comes in very handy, because then the alert goes off once the fair value gap is actually being created right there. And then once it's being created, then after that, you wait for what? You wait for a new fair value gap. So once that new fair value gap is being created as well, new alert goes off to then look to continue higher. And that allows you to take that entry right there. Just using alerts on every step right there. So what would you do here? Here, we're in the trade. At this moment in time, you can wait for the alert again to go off of that indicator for that fair value gap to be created. And right there, you would now be break even. Perfect. So there you can also go break even on the expansion phase, depending on when you actually look at that chart right there. As long as you understand, and that is the main premise right there, it is not super important to understand on the exact spot you should use alerts, on the exact spot you should do this. No, it's just understanding that overall we need to minimize the chart time. That is the important part. So you use alerts for your narrative, for the boundary. So that's one alert on where we are actually going higher from. So the PD rate before you go into the entry pattern. Then on your entry pattern, you use alerts. Depending on the specific entry pattern that you are waiting for, you use alerts right there. Then the next part is once you have that entry and you're in the trade, then you use risk management. So risk management for your alerts and your alerts for your risk management. Sorry. Your alerts for your risk management tell you when you should go break even, when you should not look at the chart, etc. And if you are break even, then you just simply stop looking at the chart. I don't trill my stop loss unless under extremely specific conditions where the market is almost closing on a Friday, for example. Then I might look at the chart a little bit more to see, all right, where are we at? Can I close this trade right now to actually get out of the trade? Other than that, I simply do not look at the chart. I'm either break even or take profit right there. Perfect. That's it. And if under very specific conditions again, but this is just the basic understanding first, if we get something and we completely disrespect everything right there, and we start going lower and we have no reason to return right there, then I might say, all right, I might trail my stop loss and I might go break even already. Other than that, there's just simply no reason to go break even here, even if my take profit was right there. We still have this 1 hour value gap right there in the making, 1 hour value gap below there as well. So here, there's just simply no reason to go break even. So I just wait. I don't do anything. I just walk away from the chart. So that is also very important to understand. And even if we create those bearish value gaps again, it's not relevant because the overall ID, the weekly right there, what will be stronger? Again, that is the whole premise that we need to understand first, where an entry pattern is always going to show up. We will always have lower time frame for value gaps. Bearish for value gaps, bullish for value gaps. There's always going to be bullish and bearish for value gaps on the 5-minute time frame, 1-minute time frame to either side of the market. Constantly. The thing we need to understand is, all right, what is the differentiator between those value gaps? It's the higher time frame. What is our overall bias narrative boundary? And that is the reason why, if you just take the 5-minute time frame, for example, you get confused because you don't know what to do, etc. What is happening overall? Because we need to understand first the higher time frame picture. Weekly value gap is a little bit stronger than the 5-minute value gap. I can tell you that for sure. So right there, you want to only look at the weekly, just following through higher. That is the overall objective. So in all those steps, in narrative, which is also the boundary, it's the same thing basically. That is one step, I count that, and that I count as one alert. Then you have the entry pattern, where you use alerts. You have your risk management, where you now also use alerts to minimize your chart time right there. Now, let me actually show you the indicator. Here is one of the alerts, and a quick thank you to Discord members as well. And that is Supras and You Don't Know Me actually also suggested an alert like this before, which is very handy right there. Because this alert, imbalance finder right there, which is, let me see, that is imbalance finder by Traveling Trader right there, which actually allows you to, where alerts go off when imbalances are created. So that is quite nice right there. And this one right here. For the rest, is not really relevant. I also don't, to be honest, and this is why I like to use a timer as well, because in my experience, indicators do also show the fair value gap itself, which I do not like. I just like to mark the fair value gaps and see them visually. Otherwise, it's quite overwhelming for me. And that leads me back to when I have an overwhelming chart, how can I think straight? Doesn't really make a lot of sense in my eyes. So what I like to do is the timer, but this is also a great thing right there to use. And we might even be able to create our own indicator right there, where we just, if we create an alert, you set off an alarm, which could be nice. And I'm sure there are indicators out there as well, which do that automatically. For example, the fair value gaps and CEs alerts, simple and efficient method by Twin Gal right there, is as well one of those where an alert goes off. So you can mess around with these right there. And you can mess around with the alerts as well, how you want to use those. These are two indicators that you could use right there. So that is using alerts again to our advantage to minimize the chart time. That is exactly what we want to do. And that is very important in your overall trading. This makes, again, that environment very easy. It makes it very easy to stick to the trading plan, to actually keep that psychology in check. And that is what we want to have. So feel free to also experiment with this and see how you would apply this. As long as you understand, use an alert on your narrative, your entry pattern, and that risk management. And again, the specific levels of those alerts are just really not that relevant. As long as you understand, we need to minimize the chart time. That is very important because that makes the environment very easy to keep our psychology actually in check. All right, perfect. Thank you.